Hello everyone, I am Srijan Ganguly. Today, I will be discussing the concept of intermediaries for microfinance, which plays a crucial role in achieving financial inclusion. So let's dive into the first slide. Microfinance mainly serves low-income individuals, small entrepreneurs, and rural households who often lack collateral, formal income proof, or credit history. Because of these limitations, formal financial institutions such as banks find it difficult and costly to serve them directly. This is where microfinance intermediaries become important. Microfinance intermediaries are institutions or agents that act as a bridge between the formal financial system and low-income borrowers. They connect banks, NBFCs, investors and other financial providers with individuals at the grassroots level. In simple terms, they enable the last mile delivery of financial services. Instead of borrowers navigating complex banking procedures, intermediaries bring financial services closer to communities. Their local presence, understanding of borrower conditions, and relationship-based approach make finance more accessible and practical. So we can say that intermediaries are essential connectors that transform financial inclusion from a policy objective into ground reality. Now let us move to the roles performed by microfinance intermediaries. First, intermediaries help in borrower identification and onboarding. Because they operate within communities, they can identify individuals who genuinely need financial support. They interact with potential borrowers, conduct meetings, and ensure eligibility requirements are met. Second, they play an important role in credit assessment. Traditional lending depends on formal documents and credit scores, which many low-income borrowers do not have. Intermediaries therefore use alternative methods such as household visits, livelihood assessment, and social reputation within the community. This helps lenders make informed credit decisions. Third, intermediaries facilitate loan disbursement and repayment collection. They coordinate loan delivery and often organize periodic group meetings where repayments are collected. This structured process improves convenience for borrowers and discipline in repayment. Another significant role is providing financial literacy and support services. Many borrowers are first-time users of formal finance. Intermediaries educate them about interest rates, repayment schedules, savings habits, and productive loan utilization, promoting responsible financial behavior. Finally, intermediaries perform monitoring and follow-up. They regularly interact with borrowers, track loan usage, provide support during difficulties, and ensure timely repayments. This continuous engagement builds trust between borrowers and financial institutions. Thus, intermediaries act not only as a financial facilitators but also as relationship managers and community partners. Now, let us understand why microfinance intermediaries are so important. The first major contribution is reducing information asymmetry. In many cases, lenders lack sufficient information about borrowers' reliability and repayment capacity. Intermediaries bridge this gap because they possess local knowledge about borrowers' occupation, behavior, and social standing. This improves credit evaluation and lending outcomes. The second contribution is lowering transaction costs. Serving small value borrowers in remote areas individually can be expensive for banks. Intermediaries reduce these costs by aggregating borrowers, using group lending approaches, and leveraging local infrastructure. This makes microfinance operations economically viable. The third important aspect is credit risk reduction. Since microfinance loans are typically unsecured, risk management becomes critical. Intermediaries use peer monitoring, group liability, social collateral, and regular interaction to create accountability among borrowers. These mechanisms have historically resulted in high repayment rates. Beyond operational benefits, intermediaries also generate broader developmental impact. They promote financial inclusion, support micro entrepreneurship, empower women through group models, and stimulate local economic development. However, sustainable functioning requires strong governance, responsible lending practices, effective supervision to avoid issues such as over-indebtedness or operational inefficiencies. To conclude, microfinance intermediaries are a cornerstone of inclusive finance. They connect formal institutions with underserved communities, perform essential operational functions, and help overcome barriers related to information gaps, high costs, and credit risk. Without intermediaries, reaching the last mile of financial inclusion would be extremely challenging. That's all. Thank you.